This is WiseScript. The markets are currently closed as of Friday, December 5th, with Plug Power Inc. ending the session at precisely $2.20, down 0.030 cents or 1.35% for the day. Post-market action saw a further slippage to $2.19. While the ticker sits silent this weekend, the data underneath this $2.20 handle is screaming a narrative that most retail investors are completely misreading. You see a red percentage and a flat chart. I see a coiled spring loaded with institutional tension and a derivative setup that is becoming mathematically unsustainable for one side of the trade. Expectation suggests that Plug Power is a broken stock, a company that has diluted its shareholders into oblivion, burned through cash reserves, and is destined to drift lower as the hydrogen hype cycle fades into history. That is the consensus view you will find on every forum and message board. The reality, however, is significantly more complex and potentially explosive. What we are witnessing at the $2.20 level isn't just a random support line. It is a battleground defined by the recent capital raise in November 2025 and a massive accumulation of short interest that has refused to unwind despite the stock recovering significantly from its 52-week low of 69 cents. The market expects bankruptcy or irrelevance. The reality is that Plug Power has just secured enough runway to potentially outlast the very short sellers trying to bury it, creating a maximum pain scenario that could trigger volatility unlike anything we have seen in the last 2 years. Let's analyze the immediate price action. Closing at $2.20 after an intraday high of $2.32 and a low of $2.18 indicates extreme compression. When you look at the chart provided, you see that jagged, nervous movement, a classic barbed wire pattern where every attempt to push higher is met with algorithmic selling and every dip is bought up by accumulation algorithms. The drop of 1.35% on Friday wasn't a sell-off, it was a containment move. The stock is effectively pinned. Why? Because the recent financing news, specifically the $375 million in convertible senior notes and the total cash net of nearly $399 million announced in late November, has fundamentally changed the liquidity profile of the company. The bears were betting on a liquidity crisis by Q1 2026. That thesis is now dead. The company has cash. This forces the bears to shift their thesis from imminent bankruptcy to long-term valuation concerns, which is a much weaker argument to hold a short position on, especially when the stock is trading at these compressed levels. This brings us to the most critical, underreported aspect of Plug Power right now, the short interest data. As of the latest reporting period in mid-November 2025, short interest stands at a staggering 305 million shares. To put that in perspective, that represents roughly 23% to 25% of the entire public float. The days to cover ratio, a metric that estimates how many days it would take for all short sellers to buy back their shares based on average volume, has crept up over 3.06. In the world of high-frequency trading, anything over 3 is a flashing warning light. It means that if a catalyst hits, positive news on a Department of Energy loan finalization, a new major customer signing, or a shift in federal interest rate policy, the door for short sellers to exit is too small. They cannot all get out at once without driving the price vertically. We also need to discuss fail-to-deliver data, which is often the smoking gun of naked shorting or administrative strain in the lending market. In mid-November, we saw a spike of over 2.4 million shares failing to deliver at the $2.49 price point. When you see FTDs spiking alongside a capital raise, it often implies that market makers are struggling to locate shares to settle trades. This artificial supply suppresses the price in the short term, but it creates a synthetic short liability that must be resolved eventually. Retail investors often get demoralized by the price suppression, not realizing that it represents future buying pressure that is legally mandated to hit the tape. Now, let's zoom out to the broader market context for December 2025. We are operating in an environment where the green energy trade has matured. The hysteria of 2021 is gone, replaced by the hard math of execution. The Inflation Reduction Act's 45V hydrogen tax credits, which were finalized back in January 2025, have now been in effect for nearly a year. The market was initially disappointed by the strict time matching and additionality requirements, which caused the stock to tumble earlier in the year. However, Plug Power has spent the last 11 months reorienting its business to comply with these rules. The Georgia and Texas plants are the test beds for this. The $2.20 share price reflects a wait-and-see approach from Wall Street, but it does not price in the potential for Plug to actually unlock the full $3 per kilogram credit. If they demonstrate full compliance in their upcoming Q4 earnings, the repricing could be violent. The volume on Friday was consistent with recent averages, showing no mass exodus of capital. Institutional ownership has seen some interesting shifts recently. While some traditional long-only funds have trimmed positions, we are seeing an increase in ownership from quantitative funds and index tracking instruments. This is likely due to the stock stabilizing above the $2 mark, preventing it from falling into penny stock territory, which often forces institutional liquidation. The fact that Plug Power successfully raised nearly $400 million without crashing the stock below $2 is a testament to the fact that there is still significant institutional appetite for this story, provided the entry price is low enough. And $2.20 is historically low. I want you to pause for a second and think about your position. Comment below. Are you holding Plug Power because you believe in the hydrogen future, or are you just waiting to break even? And more importantly, do you think the 305 million shares currently shorted are smart money betting on a zero, or are they trapped money waiting to be squeezed? Let me know your thoughts. Let's dig deeper into the reality of the company's operations beyond the stock chart. Plug Power isn't just selling fuel cells for forklifts anymore, although that remains their bread and butter with customers like Amazon and Walmart. The real story for late 2025 and 2026 is the electrolyzer business and the stationary power generation. The world is facing an energy capacity crunch driven by AI data centers and EV charging loads. The grid is stressed. Plug Power has been positioning its stationary fuel cell units as a backup and prime power solution for these data centers. We saw hints of this in the November symposium. If Plug Power announces a definitive agreement with a major hyperscaler, like a Microsoft or Google, to use hydrogen fuel cells for data center backup power, the short thesis evaporates instantly. The bears are betting that hydrogen is too expensive. The bulls are betting that grid reliability is priceless. At $2.20, you are essentially buying an option on that energy transition thesis. However, we must address the risks responsibly. I would be doing you a disservice if I didn't highlight the dilution. The convertible notes offering in November was necessary, but it does mean more shares could potentially flood the market in the future if conversion prices are met. Dilution is the enemy of the long-term holder because it slices the pie into smaller pieces. The reason the stock is down 1.35% today and sitting at $2.20 instead of $10 is largely due to this share count expansion. The company has a history of burning cash to grow, and until they hit cash flow positive operations, which they have projected for late 2026, they remain at the mercy of capital markets. If the global economy enters a recession in 2026, capital will dry up, and Plug could be in trouble again. That is the bear case, and it is a valid one. But here's where the expectation versus reality tension returns. The market expects Plug to continue burning cash at the same rate. But the reality is that the heavy CapEx cycle, the building of the gigafactories and the massive green hydrogen plants, is largely in the rearview mirror. The spending is shifting from building to operating. Operating leverage is a powerful thing. As they fill those factories with orders, the margins should theoretically improve. We saw early signs of margin improvement in the Q3 2025 report, although it was overshadowed by the revenue miss. If the company can show a gross margin flip to positive in the first half of 2026, the algorithmic trading models that currently short the stock will automatically flip to buy. These models don't care about hydrogen, they care about the second derivative of margin growth. For those of you watching the technicals, the $2.18 level is your line in the sand. This was the intraday low on Friday. If we break below $2.18 next week, we could see a retest of the psychological $2 barrier. However, there is massive support at $2 because option dealers likely have significant put walls sold at that strike. On the upside, the resistance is heavy at $235 and $250. Breaking $250 would likely trigger a gamma squeeze, forcing market makers to buy shares to hedge their call options, which would then trigger the short covering we discussed earlier. The chart is effectively a pressure cooker between $2 and $250. Another factor to watch is the borrow rate. As of early December 2025, the cost to borrow Plug Power shares for shorting has been fluctuating. When borrow fees spike, it indicates scarcity of lendable shares. Watch this metric closely on your brokerage feed. If you see the borrow fee jump to double digits, it is often a precursor to a squeeze. Currently, it is elevated but not critical, which suggests the shorts are comfortable, perhaps too comfortable. Let's also touch on the macro-political aspect. With the administration